Okay, everybody, thanks for coming out. I just want to double check. Can you guys all see clearly my ES 15-minute chart?
Yes.
Okay, great. So I have a psychology lesson planned today, but I just wanted to start out with some of these questions, and I thought they were pretty good. Oftentimes, like when we're doing the daily call, or we have these subtle types of nuances in the way that we approach it, because there is this, certain things are measurable, but then there's an interpretation to, am I seeing the same pattern as somebody else, or am I seeing something that's really not there? Just real quick, I'm going to check the chat. Great. We got a good crowd. Okay, so Shirley says here, hey guys, I have some questions regarding the daily call, and we'd be grateful if Kobe and Matt could explain the category prior momentum and others are not 100% clear to me. All right, since we're doing the daily call, we might as well zoom out of this one. Okay, so he says the category prior momentum and others are not 100% clear to me. From my understanding, after a huge move, either up or down, a continuation day seems unlikely, therefore indicating a sideways call. Well, I'll just give you a general principle, and then we'll just talk about the context, right? Because there could be different situations. So, in general, right, if you have a pure trend day, which is, a specific kind of trend day that happens about 2% of the time overall of over 1,000 sample size, but in the right environment, it might happen more frequently, is that it's unlikely to get like a couple pure trend days in a row. 2 pure trend days in a row, up or down, are unlikely. But that doesn't mean that we're not noticing a trend overall developing, which would then give us a bias where we're going to give more weight to support than resistance, right? It's not even that shorts can't work intraday. It's that sometimes if we're going against that bias, right, if we have a bullish short term or neutral bullish short and intermediate term, it's that we're taking them for tradable reactions. Like when I gave the example yesterday, if you made a sideways call, you could have shorted that divergence. That bearish divergence at the double top at the blue zone. That's a setup, right? It's not a strong enough where I say it's a bias confirming zone in and of itself where you can lean on trade location because we weren't filled. Just like today, if you were getting too aggressive with trade location, you didn't get filled. But if you use the actual buying tail to jump in ahead of time, which I almost gave as a 2-market POI, but I didn't, then you would have gotten in ahead of time. So just to answer that category about, from my understanding, after he moves either up or down, continuation seems unlikely, indicating a sideways call. Yeah, but right, we have to think about the magnitude of the move. If it's breaking structure, right, it may be such that we have time frame alignment. Like look at Bitcoin now that we have that giant bounce breakout pattern. Now, if this move started off on the bottom here and went straight line up, especially without the principle of a mature balance, right, this trend, the sustained momentum would be more unlikely because this is more recent and you have action reaction principle, right? So on this day, right, prior momentum would be down, right? Because you already had the sideways selling tail, right? You might even put down here action reaction or sideways to down, right? But in other contexts, let's just say, often if the trend is getting exhausted before the reversal candle could happen, there's often a pause day or a doji, or that takes time to balance, right? And I think a good example would be, let's just go here. What coin was it? Right? It's like you have the bounce breakdown, but it's like, do you really want to be shorting now? I mean, like, guys, people are going to be covering. Look, you have a hook from extremes. It's past 200. Right? Action, reaction. So like prior, you're not, okay, you're saying, okay, I think this has very low odds for another down day. So if prior momentum, even though this was down, right, and you're breaking balance, you're not thinking, oh, wow, now I have to have another trend day in a row after how many leg counts down. But if from an isolated category, right, you could, so it, how do I say this? It really depends on the market context. So I'm trying to give different examples of these. If the move's so big, right, from one end of the balance to the other, you could actually have a prior momentum that goes up then down. But if it's just like pausing, or if it's just in a sideways balance, like if it's just range bound, there is no edge in prior momentum. This is just, let's just go back, let's just say to Bitcoin. right? When we were range bound, the prior momentum is just, there is no edge, right? It's just sideways. It's uncertain, right? But now the prior momentum, because there's such a giant move here, right? As this was creeping up, the prior momentum was a creep up. And since we're never fading a creep up, right? We're giving maybe sideways up. It's creeping up. We're saying there's more odds for the momentum to have follow through. But if you get a giant move from one end to the balance to the other, it's more likely to have an action or prior momentum would be action reaction, and it would be exhausted. So that's one example. I know we kind of said that a little bit, but yeah, in general, it's like, well, this will probably, because we're breaking balance, and now we have intermediate time frame alignment on the short and intermediate time frames, and we're breaking a bigger picture pattern, right? And we have gaps that will probably continue to here, but I can't in principle say now you have to buy this because you saw it. I mean, we're anticipating this creep up. Now, usually markets are fractal, so I was anticipating on my moves 100% of this break, and that was a fairly conservative. But like once we closed above that, and we already had that move, it's like we have to be aware that eventually this giant balance is, every balance will eventually resolve itself. And the more mature it gets on this daily, I mean, this is a multi-month giant pattern. Now, that doesn't mean that once we get to the big picture resistance, I'm not ignoring this stuff. So my bias then will become more neutral when I come up here. And the idea of neutral bearish is that, the short term is potentially overdone in the short term. And the idea is that, with the ES, I can use more intraday things, because I can look underneath this index and see, okay, is this momentum sustainable? So that's why even in these types of environments, if you're not seeing sustained momentum, extreme conditions at these blue zones, double tops will often work. And even if you didn't have faith in the what I deem the interpretation of the initial blue zone, which is the initial resistance on the day yesterday, let's go on a lower time frame. You could say, hey, I'm neutral bullish or whatever. I need to see something else on this lower time frame. This was yesterday. Now, keep in mind the zones are a little different, but the idea is that at this moment in time, which was 1 hour after the open, let's just check out the internals real quick. And I'm going to get to the other questions too, but I think this was interesting. See, as we were going up into that area, see, the last time, even if you didn't want to take it on first test because of whatever, you say, hey, man, this is a 1720, take holding, I just want to wait for that intraday double 60-minute wide thing. I totally get it. And you might say, hey, I don't know if I would take this one because maybe it wasn't wide enough for you. Maybe visually you could only see it on like a 30 or a 15. I get it. That lowers the odds. It's all about, I don't care if you take a loss or if you want to go in on the yellow, if you see a bullish divergence or whatever. The idea is that you following correct process. Now there's nuances to it. Like if you jump in early, okay, fine. You're going to get in more often. Your hit rate might be a little lower. You're capturing more moves, right? But if you wait for the back to the end of the zone, like I sometimes do, well, you're going to have a better risk reward ratio. So depends on how aggressive you want to be and if you want to jump in. So if I jump in early, I have to see something, and this is what I use at least for the ES, right? So as that was coming up, right, at that moment in time, we could find it here at 10:30. Price was basically at the same level as this moment in time, but yet this was way off from its high. Guys, this is an automatic short. It's just that, I'm following the system correct process. I made a sideways up call. So I'm going to, follow my overall strategy, which was to hold through that. But that was a perfectly fine short, as long as you have the understanding that I had to probably see divergence to go against that neutral bullish bias, because eventually we did break it. And if you take it, you're not thinking, okay, I'm going to walk away from the computer with no target, and now I'm going to hold for the low of the day or something. Because going against this, you're basically, if you're going against maybe even the intraday bias, or if I have different time frames slightly aligned up, you're doing this for a tradable reaction. Even if this did break, you should probably take profits at the mid or VWAP, like one of these, the orange dots, or even, this movie, you want to basically scale out on this. And with the understanding this is for a tradable reaction. One, the first reaction on this, was mediocre. That's kind of giving you a hint. And as we were coming down into this, we could look exactly what was happening at 10:45. Right? At 10:45, as this is coming down, we're basically have a tick that's above zero at 312. I mean, that's not really what I want to see if I think this momentum is going to be sustained. And the AD line didn't even have to be doing anything. It could have just, it was just following the price. So it wasn't confirming or denying anything, but even without the tick confirming, basically the higher time frame context and the bias was up on that day. So like I said, tradable reactions are a little bit higher risk. Maybe I'll start posting more of those with yellow. But basically these blue zones are double tops are usually, if I say, hey, don't fade this, most of the time I'm taking those. And if I am going against the bias, we needed to see this. So hopefully that example helped. The next question is, let's see. So hopefully I answered the second part. He said, if my observation is correct, what situation would indicate for a sideways up or down? Hopefully the down was if it was super extended from one edge of a giant balance to another. That would be almost the opposite. You'd be action, reaction. If it's just exhausted and you're thinking trend continuation, you're thinking just a pause day, then it would be sideways. Also, even if you're thinking reversal, because we're into some giant, bigger support and it's short-term exhausted or whatever, the intermediate trend, and now we're in a big picture uptrend, you'd still would be sideways because you don't think this thing is just going to go up and have a bullish engulfing pattern and eclipse it, because you have to realize that there's people that want to get out of break even. So even if even if you're sideways psychologically, emotional capital, you don't have to take longs and shorts in the same day. If you're up for it, you can. You have to be very nimble in your ability. But sometimes a sideways call might say, hey, I'm just going to short these double tops, and that's it. Or get a wide double bottom and see if we break the high of the day. I don't have to take it. So if you were sideways up, you could have taken that or done nothing. So that's what I kind of said. So that's what I did. I did nothing. So sideways up. So this was that CPI number, and the volatility was very much increasing. It wasn't in line with my zone, so I almost posted my yellow low probability target, which basically I jumped into market here. I didn't see enough to give it as a POI. I almost did. I'll start giving those more, but for the new guys, when I give a yellow limit order, if it hits, it's a lower probability event, but the green is probably higher probability. So that one was basically to the mid of the back of the zone, which didn't get filled, But once I saw it pause there, whatever, and there was, at this moment in time, let's just go there at 9:45. And this requires, on a day like this, more than an advanced read. So it's like, unless you have these skills a little bit with the tick and things, like it's just, stay out 30 minutes before and after that. Really, based on the previous zone, if you didn't take that, and I apologize that I said that after the fact. It's just I've said that so many times just for some of the guys that are new. Basically, if there's a news event that we're talking about, it's going to be a market moving news. Usually it's an FOMC, Federal Reserve, ZOG is going to be doing something. So the whole market moves. It doesn't have good news up, bad news down. No, I wish it was that binary linear. It's really, look at this one. This was just sideways, but super volatile. So pretty much stop out. All the little guys that had their little zone were getting stopped out. But basically, bigger time frame players were at war right here. And why get caught up in that if you can't read it? Let's go on a different time frame. Just get rid of that a little bit. So initially, this was the yellow target. This was the if you weren't using zones, the other way to do it is from the body to a buying tail to the top. You just go halfway in and you put your limit over there, which is perfectly fine as well. You don't have to, these zones just help me psychologically. You can use basically intraday price action. If it's a sideways call intraday and you have this much information, you could walk away from body to the low. You could even put it up here. And it's still the stop here. Okay, so you get in at 65. You're going to have your stop at least a point or two behind, at least, even if you were using my zones for some, the one principle for the guys that are new is that if you could get a stop behind a zone, and 2 lines are a zone. This is blue zone. That's usually a zone that if it's a sideways or sideways up call, it's usually going to be taken, especially if I say bias changing or it's confirming. The green is stronger, right? So bias confirming changing means that if we break this, okay, the bias now is not going to become neutral. We're going to be starting to flip our bias even bearish, and this then breaking that confirms it. But that doesn't mean we're not taking there, especially if we're seeing things. We're not seeing overall weakness because in this environment, just a lack of strength, especially with this price action. I mean, this intraday buying tail is notable. If you go to the hourly, if you put your limit order here, you'd have to have the psychology to again get stopped out and put it here. Initially, I was going to post that, but then my thought was, man, for the new guy, I'm psychologically prepared to take a 2R loss because our risk system management, our loss is a fixed percent. So if you do get stopped out here, you get a 1R loss. Your entry would be your stop loss for this one would be right at the entry here, and you get filled again. And then if your stop loss can even be behind another zone. So that's why I post a conservative entry, because with a 10-point stop, you're beyond these 2 little red zones, which I diminished. I wanted them. This is something that's just to be aware of. They're previous little HVNs, but the big one down here, right? I can get my stop loss at least close to that. That's giving me an edge that at least I can get out with a quad exit for a tradable reaction if I'm wrong, because trade location can even give you a great edge even with you're wrong. But the flip side, if you're a precisionist and you didn't give the lower probability one, which was based on the candlestick from the high to the low, which got you in, then you either missed it and be okay with it and you didn't get in here, or you're willing to take 2 losses here. So part of today's lesson was, okay, so if I am going to post those 2 at the same time, which I've done, I think, a few times, but not too many, because the day that it's a 2R loss and I don't go over the psychology of it and someone shadow trades me, I'm going to feel some pain through resonance, and I'm going to say, hey, I should have at least talked about it. So one of the ways that we can have emotional and mental state control for this is already visualize that already happening as you take it. Like, just visualize the worst that can happen and be okay with it and say, okay, I'm just simply following correct process. And then when the fear comes, and I was actually going to do this in real time and post it in real time with these 2 orders. In real time, just go to your journal and basically you can even release the energy just by writing about it, and you can release the fear. Forgiveness really is what comes to mind here. Because, you have to forgive yourself for feeling fear when you fade as the price is coming down. I mean, in principle, from going from one end down to the extreme to the other was even increasing the odds that this was going to work down, even though in the body, the emotions posting live, it didn't feel like that was good. I'm like, oh, this is heavy. But really, we know if it was creeping down and then you feel like creep down, creep sideways, creep, that's worse. But that's psychologically, that's why it's harder that's easier to fade in the body, but wrong in principle, counterintuitively. And this is from the high from one end to the blue zone to the end of the blue zone of the main support resistance zones on the day. That's exhaustion principle. And that's actually hopefully, surely that this on a smaller time frame, this hourly, answers that question about the daily, as well as Kobe just joined as well. Not that he has to, I don't know if he's capable of, because he might be on the road today or whatever, but if he has, surely he was asking questions about the daily call sheet. Yep.
Capable. Trust me, I'm capable.
Right. Yeah. All right. We're good. We're green. So yeah, we're in the process of answering his prior momentum on the daily call to me. He said he's not 100% clear to me. He said, from my understanding, after huge moves, either up or down, a continuation day seems unlikely. Right? I agree with that. Unlikely, therefore, indicating a sideways call. If my observation is correct, what situation would indicate for either sideways up or down, et cetera, within that category? and we also went over some of that. Maybe I'm completely off with my understanding, hence I would appreciate some examples. And then his next question is about candlestick patterns, but we didn't even get there yet. We were just about to get there.
You want me to be capable?
Well, yeah, I mean, so if you wanted to comment on,
Okay.
Just to double check it. Yeah.
I'm not sure. I would actually like, if possible, you to ask me that question yourself, if that's possible, instead of me interpreting the written one.
Okay. Sure, Kobe. Hi. How's it going?
Very well, thank you. How can I help?
So basically, my question is regarding the prior momentum category in the daily call. And from what I understood, in general, every category in the daily call should be taken in isolation. So
it's absolutely imperative. So that's correct. And it's most likely the most important part, because when you, and here's the principle underlying, and this is used against you all the time in advertisement and in all kinds of stuff. I'm sure you know that rule when people say 3 times yes, when they basically say, are you a girl? And you say yes, if it's a female customer. And then they say, did you wake up early this morning? And she says yes. And then the third time, yes. And then the fourth time is basically something related to the product. The likelihood of buying is a lot easier. So we have a mechanism in our mind that we get biased after a certain amount of agreements or disagreements. So when you try to assess the market while it's in real time, and you by pure chance would say, oh yeah, this looks like going up. Oh, and it goes up because of moving average. Oh, it goes up because of, and then you have subconsciously already made up your mind. This is going up. And worse is if you're looking for a long setup, you already have, by just having said I'm looking for longs, you already biased. Two more things that you're looking for confirmations. You find 2 more confirmations, and you're in your mind, you're long. That's it. There might be 5 other things, if you would go through all of them isolated like you do in the daily call, that are all saying, no, this is not a long, no, this is not a long, no, this is not a long. But you are not objectively going through these questions any longer because, as you said, you already made up your mind, not even knowingly to yourself, just subconsciously, that this will be long. So the daily call has 2 differentiations. A, you are not in a moving object. You're supposed to look at this from a daily perspective, which doesn't move much, especially if it's stocks or a market that closes, so that it's actually not moving. Or if it's a 24-hour market like Bitcoin, you should be looking at a time shortly before the rollover, which is typically in the afternoon, at the end of the day of the session. That's also not that busy, so you don't have that much movement, which doesn't create stress, because stress is accelerating that principle. Meaning, under stress, you want to be done with your decision quicker than not, because you want to deal with the other stress factors. So that's one advantage. The second one is it's not a time for you to execute. So you also a lot less biased to do something, because you're separating analytical times versus active time. So this is also hugely imperative. Please, everybody listening, do not ever, while you're executing, just because it might take another 15 minutes till your entry is coming. Okay, go back to this other chart and I check whether. Never ever mix execution states with backtesting states or analytical states, because your analytical mind functions completely different than an execution mind, than a hands-on mind. So when it's time to shovel and dig the hole for the foundation of your house, that's execution. When it's time to say how big that hole is and talk to the architect, that's analytical. Don't do this at the same time ever. And the third part is exactly what you pointed out. With the awareness that the one who is able, which is the one which will be me, says don't ever mix these things up, but do them in isolation. You will be less biased. So for example, I sometimes change the components. I take the momentum out and put another thing in. I change the order of 1, 2, 3, 4, 5, 6, 7 to not be biased from going with a fresh mind to the first 3 and then starting to be biased and going through the rest. So I do all kinds of ways to trick myself to try to give each of these different aspects under which we're looking at the market its own free weight of doing so. At the beginning, I even had different workspaces where in one workspace I only had the moving average, in another workspace I only had the maximum excursions. In the next workspace I only looked at the candlesticks with nothing else. So that's a trick if you have problems with this. The only thing that's an exception is these last 2 questions where you're assuming that you're in a short position or you're assuming in a long position. That's something where you actually want to evoke these emotions. This is something where a whole picture comes together, where multiple things of however you look at the markets play a role and you can be biased, because this is where this is the classical rule of 80-20 that I always employ, which is 80% rule-based, 20% discretionary. That's where your experience or your hunches or your whatever else are allowed to come forward. So sorry that I made this lengthy, but this is really important. The whole daily call is absolutely worthless if you just try quickly to go to these questions, but questions 1 and 2 are the only ones where you're not biased, and as soon as you made up your mind, the rest is basically just all tainted in this aspect that you want to go long the next day or something like that. Okay, that was that. What was the next? I forgot if you already added the second question. I'm sorry.
But I still have like one thing left, because what I don't understand is that so basically, how should I measure the different sort of states within that momentum category? So, for example, if I have a huge bullish candle, as I was writing,
it's rules. You have to have rules.
Okay.
So, what would be your rule? Let's establish these rules if they're not clear. What would be your rule if it's a huge bullish candle?
Yeah, usually I would say it's unlikely that the next candle will be a follow-through, a direct follow-through. So I would say the next day will be a sideways call.
That's good.
So
the huger it is, the less likely that obviously position plays a role. So it doesn't have to be absolutely isolated. If that huge candle ended exactly up at a support, as a major support resistance, let's say it's ended up at the 200 moving average and some other stuff, then it's more like a sideways call. If the huge candle just broke out of a major tight range, then it's not a sideways to down call. You know, when it's more like a sideways up call. So you don't want to stack it with all your other elements, but you basically, it's just, here's the real underlying principle. We have a daily call that's categorized into 5 categories: sideways, sideways up or sideways down, and up or down, and uncertainty. So 6. But that's not where this whole thing ends. You can be way more specific if you like. It's just the goal of this thing was how this thing got developed or redeveloped, I should say. I do this for a long time, but when I made the daily call public, so to say, which was at Midas Touch, was that it was a very good tool for advertisement, because it was, for example, Twitter conducive. It was one picture where it said what not to do with that little box of those 5-6 different categories, and And then later we added what's a high likely probability play possibly for long-term and for short-term players. And then you had a little window where you could brand it. So it was something that you can send out every day as advertisement, but that's not the origin of the daily call. The origin of the daily call, and you cannot really expand it because you only have one picture, so you cannot like make endless text. You cannot make whatever. But what I do for myself on a daily call basis is I'm way more refined than just 5 items. But you also don't want to do this when you're just starting out in the first, whatever, 1 or 2 years of doing the daily call, because then it gets really quickly confusing again. And this thing is supposed to help you the next day to minimize your options and to minimize your tool set. But as a general, take all these edges into the analysis of the daily call that you feel very confident in. So, for example, if you use GAN theory, or if you use Fibonacci's, or if you use whatever you use, you don't have to use the categories that with that sheet that you have right now. You can use all kinds of ways. And then the ones that so the most important ones are the ones where you say, well, this is my favorite indicator, and this is my favorite, and this is my favorite. Just be sure that you balance, that you have everything in. So it should be one oscillator, one indicator. So you're covering direction. And for support resistance, you should have trend lines, not only horizontal ones, but also directional ones. Then we have already momentum that we're talking about. Then we have the two where it's a bias of an emotional perspective. But for example, if you don't use moving averages, you certainly don't need to become an expert in moving averages. Now you can just use whatever you use. The daily call also works for people who use charts without time. For example, it's just a principle-based idea of not to get into stress situations in real execution, and reduce data load. Because if you have a bias where you say for tomorrow we're sideways up, then the rule is don't short. That cuts out 50% or more of what you have to look at. So you can, instead of an hour, focus now for 2 hours, because I don't short. I don't look at shorts. Just don't look at the shorts. So there's a lot of stuff in the daily call that really makes your trading just immensely more easy. And the way how I structured this model because I also have different models for different markets that you're using right now, its main focus is that you just don't get a string of losers. And that's what everybody struggles with. Because if this thing goes up, let's say it's a trend day, and you find yourself in the middle of the trend day, you go to the beach. That's it, because there's nothing for you to do. If you didn't catch the opening on a trend day, the first 15 minutes or whatever rule set you have, that is it. But what everybody does is, well, all that's left is shorts. Yeah, well, maybe it's not a trend day. Maybe I try here. Loser. Oh, maybe I try, but now it must be over. The worst is if it's a creep that feels all the time as if the shorts are coming in, you can end up whatever with 10 losers in a row. And at the end of the day, like, why did I short this? This is a trend update. I could have told you after the opening session. It looks all clear, but it unfortunately always only looks unclear after the fact. So that's the most important part, and that maybe already diffuses a little bit your question about momentum. If this is one of 8 categories in your daily call, and let's say you struggle with it a little bit, there's no problem. You do not have a problem, because the weight of this thing, and this is the important part of these separations again, becomes minimized. The general thing is just, this is an action-reaction principle. So you're absolutely right when you say, I have a lot of movement, then I can expect a counter movement or at least a break. And that helps, since we're trading the quad, and the quad lives on that counter momentum a lot, it really helps a lot to get positioned, because let's say you have a strong down movement and it goes exactly into a support zone, and then you already know that you're not trading tomorrow. Because when are you trading? When there's a small doji there. Most likely there will be sideways. One sideways day. You don't want to be the first in the action-reaction principle where direction just got a strong bar against you, so to say. So you have off. The next day you have off. Maybe if you're really good as a trader, you'll do what I do, where I sometimes position myself a little bit earlier at the last 90 minutes or so of the session. But it's really easy to just cut your workload, to just say, well, this is too early. I don't have to do anything. And you certainly, as you just said, the likelihood that after a trend day comes another trend day is, you don't want to take that risk. And where is that stop? If you have a gigantic candle, where do you basically start to be a breakout trader? And a good example is what we have right now with Bitcoin. If you have Bitcoin, which is an exception, which is this classical, once this guy breaks free, she's just moving. She's just like one green, and they get longer and longer, and there's no way in. So my methodology, or what we're doing with the quad, you have some from below and you have some runners left over, and then you get all these confirmed entries on the larger time frames, weekly and monthly, and everybody's already. It's really difficult emotionally to do without these rule sets to step in and say, and now we're opening a weekly position. But you saw what happened. We had literally zero risk. There was no coming back whatsoever from that entry. Forgot what the number was, but you have all these charts with these little white loops and the risk measure to the side that I posted. And it takes 2 days, and you already have first and second target of a weekly trade in 2 days. So these combinations of determining to just say, I say what I will do, and I will do nothing else, and mostly I will absolutely adhere to the rules of what not to do. And then I have a tool set of what to do, and then I pair this with the category or with the characteristics of a special instrument, allows you to take these trades that everybody else is missing. I had this talk with a trader who said, well, I'm not in the gold move up long. And if you look later, you say, well, it's a super wide triple bottom. But I remember how difficult it was to step into this triple bottom trade myself. And then you need these options of the first reloads, so to say. It would be reloads if you would have taken the lows, and it become original trades or confirmed trades if you don't have the lows. Otherwise, you just, like many people, I'm sure, they would love to be in Bitcoin, and they're just not. So that's the underlying structure of why we have these methodologies of being pre-prepped and then being able to take the trigger even on larger timeframes at very late levels where significant move already has happened, as in Bitcoin. But if I understand it correctly, the main problem was that the quantification of the momentum move is what. Okay.
True.
My rules in general are I first do this unbiased thing, which is, do we have momentum? And this is literally the most important part: is there a chance that I get action reaction principle? And if this is a retracement in direction of the trend, I'm drooling, of course. That's all I'm looking for. Because I know, let's say you have a long and it moved nicely, and then comes finally that retracement that everybody is waiting for right now. Bitcoin, it's not coming because it's a different animal. But let's say it's a regular thing like the S&P, then the retracement comes. And if that retracement was on momentum, you're in heaven, because this is the most low-risk trades. You often don't even need to wait for a doji or a break or an uncertainty. You can step aggressively into this thing depending on what your other edges are that are present at that time. So for me, since my biggest goal is, I couldn't care less whether I'm right. I mean, it's not true. I have an ego, and I I'm gleeing like everybody else if I'm in a trade where I was right. But from an execution perspective, I can honestly say I have trained myself to just look at a low risk idea. Because if you have a fairly good hit rate, it doesn't have to be what I'm trading. It just has to be a fairly good hit rate. So anything that's somewhere in the mid 60s or let's say upper 60s is just fine. And you're disciplined with your risk reward ratio, which in this case I would say if you're somewhere in the mid to upper 60s, you should have a 1 to 2, 1 to 1.7 and higher for financing. Then all you want is momentum. Literally, this is all you look for, because momentum means you get financed, and financed means your risk is zero. Once you're financed, and you don't have to trail your stop yet. That's the nice thing. You have if you're financed, especially for 1 to 1.6 or higher, then you're the winner. That's it. You're the winner. How good the rest will be is literally not that important anymore, because you already have a higher than 50 to 50 chance. You have for a trade entry, and you have for winners and losers, and you have a little bit of a risk reward ratio. And if you then just have the discipline that the other two exits do catch once in a while a trend or a follow through, you're in business. You're making money consistently, which is the only goal there is. Consistency. So momentum from that perspective comes into play because you can build a system around it. I would say if you just take two edges where you say, I take a higher risk probability entry, which means a hit rate where you just take whatever, you stack some odds, and you take that with only momentum and you apply the quad. That's the three golden rules. You're done. That's it. The rest is refined. I mean, obviously execution skills and psychology, but from a technical analysis perspective, that's the golden trio for my trading. And you can find that if you're a little bit flexible with instruments, because some instruments die out and there's never any kind of there were years where there was never any momentum on any kind of bond trade. Well, then you cannot trade bonds. But if you have a small portfolio with a few different choices where once in a while there's momentum, and obviously in these years that we had, and I'm pretty sure in the next 2-3 years to come, there will be no lack of momentum. Then all you have to do is be disciplined and only take those. Take some nice trades where there's a little bit support there. Wait for the momentum in the direction of a move or sideways trades, double bottoms, double tops, and get financed. That is it. That's literally. That's if somebody would say to me, "Give me the holy grail," and I would say, "Well, there is no such thing." That's the closest there is from and that's obviously just a very specific and a very limited universe because there's so many ways to do the market. But for me personally, and for what you're observing me doing, that is it. But I didn't mean to now put more weight on momentum for you where you're struggling with it. Quite the contrary. I'm just trying to simplify that you can make rules. You can say, well, momentum plays a role more in this situation or that situation. They can bias it from sideways to sideways with a direction. And overall, never sweat it, because you can just say, yeah, well, this is 1 out of 8 things that I'm looking at. If I struggle a little bit, I'll just write these rules down however I want to create them for myself, and then extend on that by just rehearsing and getting more comfortable with it. And why I'm not writing this into stone is because that knowledge that you already have is not that much incongruency of what I'm doing, meaning the idea always with all of my teachings is that everybody has the opportunity to make this their own. If I would write everything like all these guys sell whatever, these $3,500 courses online, and everything is very precise and very very organized, and it doesn't leave room for the personality. You cannot trade somebody else's thing because people already see colors differently than others.
Mm.
Some people look at blue and say, "But isn't this green?" So how can I, with that variant of individualism, try to make something? Well, then I give you a code. You just have an automated system, and those, unfortunately, I cannot do because I don't believe in them. And from a very simple perspective, that I think that the market is too complex. It has too many variables. And in principle, all the sciences find their limits in the degree of variables. That's why I believe in the 80-20 perspective, the embracement of the individual trader. So it is just important to take in consideration who you are, what you're after, all your choices that you make in regards to trade frequency and markets and time frames, and how you want to execute your trades, and where your shortcomings are from whatever hangs in your closet, of from unworthy to impatient to whatever it is that the market will put its finger on the wound. It doesn't make any sense. I don't think that any of these cookie cutter things make any sense. So now to go back to a more specific answer, I would classify these 6 classifications with a little tighter rule set than just whatever you have right now. I think that you're at least halfway there anyhow, because that first answer was absolutely correct. And I would give it a little room of just say, well, this will come to me throughout practice, and it's not that essential that I have to get this as a majority point, because I have how many else other qualifications, and it's just an eighth of it or something like this.
Okay.
Quite the contrary. If sometimes it's good, if you struggle with something, to just let it be and focus on the stuff that you're very confident with, and then the integration later actually will be easier than trying to master it all at the same time. But that was just, you can specify more if there are specific issues, and we can refine this. We can refine the rules together. That's fine too.
Okay. So one question would follow. So from your experience, do you think it's better to sort of try to quantify it in order to sort of enhance the rule set, or are you sort of doing it are you like visualizing it, because everything is relative.
No, this is exactly it. This is with momentum extremely the case. So when I said that this is one of the very few that cannot only be looked at in isolation, is for example, this is very dependent on the beauty principle. If that momentum candle is on average the same than the momentum candles in that instrument, for example, Bitcoin lives on momentum candles. You have like 8-10% intraday momentum candles. And the weight is obviously very differently than if you have a market that was dormant for 6 years, and out of a sudden it becomes limelight because it broke out of a congestion zone, and we have whatever, half a year, a lot of momentum candles. So these relationships, like momentum to momentum, would be, for example, one thing with how you can quantify it. But as a general, when you ask me, is this a quantifiable thing? Compared to many others, it is less. And that has to do with if you go to the smallest unit, which would be intraday scalping, then this is definitely something where you can look at the tape and learn a lot from the tape. But this is not something that you quantify. This is a skill that you make your own inherently. So this is something that you feel, okay, it pushes a little more. One last squeeze, and then I typically count to 6. And my 6 is not 6 seconds, it's probably more like 3. And then I buy this thing. So if I have this push against me and it starts that I want to go in, I'm like, okay, hold on. This was the first push. Comes a second push. Comes a third push. Comes 3 seconds and go. Just as this would be a quantifiable way to describe to you what I'm doing. But all the sub modalities of what time frame was I talking about right now? Yeah, we were talking about scalping, so obviously we're somewhere on the 5 and the 1 minute kind of thing. And what goes through my brain when I look at the tape, and what all else goes subconsciously through my brain or from my experience, that's not a quantifiable aspect, because momentum is something. It's like you're on a motorcycle and you're with 120 on the autobahn going to a leading curve. This is not something where I say, well, the degree angle is 67% or what. This is just the wind in your hair. It's a different thing. While if you take the transmission apart from that motorcycle and you have all the parts in front of you, now you can like absolutely with super German precision say, well, here we have this much leeway between whatever A, B, C, D, F, G. So I think momentum has a lot to do with experience, and momentum is a live thing. It's also I quantify different momentums. The momentums that are one extreme would be the creep. Why I always say the creep is the most counterintuitive and never short a creep, is it's absent of momentum. And this is why you all the time feel like, oh, this is going to roll over. It's over, but it's never over. It is just never over. It creeps and creeps and creeps forever. So never short a creep, up creep. And if you get momentum, and now to go to the all. This would be the extreme on one end, and now you go to a blast of top of a move, where there's this last gigantic move, and you get this dragonfly doji. That is something that only those who can fade, who can take a contrarian position. So it is the same counterintuitive than the creep. Because you would never, after when the rocket basically takes off, you're not like stepping in intuitively to short this, and now basically take the gray shades of everything in between. So creep on one extreme side, blow off tops on the other extreme side, and then these things in between. But you cannot necessarily measure this with just the length of a candle or just the you obviously don't feel that momentum when you do the daily call, but most likely you were present on that day trading, and you know what kind of momentum was present. So how much you want to refine this depends on how deeply you want to go down the rabbit hole. I by now, I'm pretty crude with this because I trade so many markets that I'm not like sitting there. I make a daily call in, I don't know, maybe 8 minutes per instrument. And I go about 15 categories let me actually look. 14 categories right now. So it's a little bit more than what you're looking at. It's about double than what you're looking at right now. But these things should become routine. I go through these things pretty quickly, because that also allows that you don't get that bias. You don't want to get stuck into this one thing and say, I don't know. I'd rather revisit at the end if I'm stuck with something. Either it's an uncertainty right away, or I jump it and go to the next because I want to go with this flow of this neutrality, where I literally just, as mechanical as possible, go through these individual fields. And if you, for example, would struggle with momentum, and take it as the last one, so that you have that flow to the first 7, or let's say the first 5, because then 6 would be the momentum, and then 7 and 8 would be those biased. How does it feel to be short, and how does it feel to be long? Maybe that's a good starting point that improves this. Mm-hmm. Did that answer your question?
Yes, thank you.
Good.
I have
anybody else?
I have two more questions, but
okay. No,
I've taken so much room today already, so I don't know.
No, don't worry about this, because everybody learns from somebody else, and many people have the same problems. Okay. Quite the contrary. We're grateful for and you're on a roll, so just go ahead.
Okay, so basically right now I'm learning the daily call, and I'm practicing a lot. So I was asking myself regarding the category candlestick patterns. I understand that there is a classic reversal candlestick pattern, which would probably indicate either a sideways up or sideways down call. And so
no,
there on
hold on, it's wrong.
Wrong? Okay.
Yeah, when you say if it's a classic reversal pattern, I'm assuming that you're talking from long to short, then it's not a sideways up, because that's not reversing, that's going in the same direction. Makes sense? You have up.
Yeah.
And then comes a doji, which is basically a breaking point. This is just a pause. It's a point of uncertainty. But if you then have a reversal pattern that you get, let's say, a dragonfly doji on top, then you have first you have a pause, then you have an indication for short.
Yeah.
And you're right. This doesn't have to be right away a short, because it depends where's the location and whatever else. But it is a reversal pattern. So it's a sideways down, or a down. But it cannot be a sideways up anymore, because it's not a reversal. That's not a reversal pattern. Makes sense?
But the reversal patterns, they can occur either at the end of an uptrend or at a downtrend.
Okay, and there's a misunderstanding on my end. If you included both sides, I thought you were talking from one side. I apologize.
Okay, no worries.
It was a misunderstanding.
So I think you once told me there is a good side, I think from Bulkovsky, the pattern side.
Yeah.
So I was looking through that side, and he's categorizing the candlesticks patterns, and one of the categories is top reversal patterns, and there's also continuation patterns, etc. So there's plenty of choices, and I was asking myself, for the reversal ones, I have a clue, but the direction of the next day probably will be. But do you have understanding what candlestick patterns are indicating pure sideways days, or aren't there any?
I have this absolutely simplified, and I think I wrote something recently about that candlestick. Here's a general notion that happens. Everybody wants to be special. So if you have a spaghetti arrabbiata that has 3 ingredients, it's olive oil, spaghetti, and a chili. That's it. And whatever, salt, but that's often not mentioned as an ingredient. And then somebody writes this into their cookbook, they want to make it special and say, let's add some chives, or let's add some onions, or let's add some butter and olive oil, or whatever. But the point is, this thing is a 3-ingredient item. That's it. And the skill level to cook that spaghetti al dente, to be able to identify what's a real good cold-pressed first-class olive oil, and to get the right habaneros, whatever, that's where the trick lies of the product quality and how you prepare this. But people have a tendency, to not even have the skill level to cook difficult dish, because this is actually a very difficult dish to do very well. To do that, so to make it their own, they just add an ingredient, which they completely ruin this whole thing. And that's in trading the same thing, which is there are some people like Bulkowski who literally go through everything. There's gazillions of whatever. And then there's guys like Steve Nissen who made all these translations of this stuff from the Japanese from a few thousand years ago, who fumble a little bit around with it. And you don't benefit from that. What you benefit from is, okay, how does this work? What's the principle and how can I reduce this? So the only thing that I'm using as a candlestick is I use maximum 3 candles. I don't use any kind of 4, 5, 6, whatever. I use location, which is candlestick pattern in an uptrend at a nowhere lands where there is no resistance. That's not a reversal. That's a break. So I value basically where this is occurring. And I simplify this thing. My tomorrow determination is not on candlestick. My determination is on 14 different points. So I'm just looking at, do I have anything that indicates that my direction is over? Do I have anything that, if there was direction, then there was a break of a doji or a sideways range, and then I get a strong rejection. Okay, now you have my attention. So don't over quantify and qualify candlestick or anything else. As a matter of fact, just take it as another edge, not in a trying to be sure, trying to be right, trying to get it right, but just in a, okay, this looks sideways. From a candlestick perspective, this looks continuation. This looks, and if you then use a dark cloud cover, the biggest thing that I always do with is I try to imagine how these people feel. If you're looking at that chart that we're having on the screen right now, comes this first after that orange box, red bar. Let's imagine it would be a daily chart
with the huge wick.
With a huge wick to the up.
Yeah.
So what I'm thinking is, when I look at something like this, is everybody and their mother before that bar, the last 5, 6, 7, if it would be daily, the last week basically, they all lost money. They all either got stopped out or are deeply in the red. So would I assume that there's a possibility that after that red bar comes more move to the downside, even though it sits in brackets a little bit higher than support? Yeah, absolutely. Everybody is like, all the bulls are scared. They're all scared. And most of them, only those guys in that orange box that are in the that bought basically at the very lows of that orange box are still in the green. So, and that rejection on top of it, with that wick, that's like, okay, these levels were highly rejected. So this is how I look at this thing. So let's go 2 bars further. We have that green bar, that long green bar, and we have a double top. And then on the double top, the next red bar makes it in brackets a triple top or double top, however you want to interpret it, doesn't matter. And it goes halfway into that green bar. So what's happening now from that last green bar perspective? Half of the people who bought in that green lost their money. The other half, and not everybody is trading a quad where they're all happy and financed in this other green bar. The other half of the bar is certainly shaken up. So do I necessarily think that this is continuing shorting? No. Why? Because it's a momentum bar. We got strong momentum from the top, and it's a counter momentum to the green momentum up. So what happens next is that uncertainty bar sideways. That's exactly what I would assume at that point, because maybe this is just a 50% retracement and we continue, or maybe it's a double top and we go further down. But I don't anticipate that we're wiping this other bar right away out, so that we're getting a doji afterwards. And yes, this is not a doji, but I consider this in relationship to the previous two moves, and this is how I read this. I don't read this like, I think about psychology. I don't think about, is this Steve Nissen probability open close at the same level, whatever. No, I just think about what I just said. Green, okay, the bullseye, yippee, double top, 50% loss, not so hot. What's happening next? I don't know. Because the shorts, they're also, I don't think from the perspective that they all got financed. The shorts just like, they have a nice double top, but hey, they still have a way to go, especially if you look at that whole chart with that huge doji on the bottom, with the sideways. It's actually whatever. That's a volatility sideways bar, the previous one. So, and this is a pretty unusual chart because this isn't the daily one. So this is how I go through this, and I do not try to get mind fucked. You just like da next. So since we're all very familiar with candlesticks, that's to me the easiest part, where I certainly do not take longer than 30 seconds to, okay, sideways, more like, and we have uncertain. So if I, when, for example, that bar where that yellow circle is, that bar after the first red bar, this is uncertainty. This is hands off. This is absolutely hands off, because if you're looking to the left, you don't get a risk reward ratio together, because if you say, well, this is uncertainty and volatility and maybe this goes back up, then you have your financing point at that red level. So that doesn't help me. I don't get a risk reward ratio together from a candlestick perspective. So I'm not only considering where this is going, I'm also considering, is this of any use to me? Can I work with this? And I can't. From a candlestick perspective, that next day after that bar that we just discussed, the one with the yellow circle on it, you do not have any edge, because that's what that bar said. It says uncertainty in high volatility. And that's not something that you want to trade. You don't want to trade uncertainty and high volatility, because high volatility means more risk. While the other one, let's go on the double bottom, 200 moving average, to 4 or 5 bars further, and that's like bet the farm. And I'm obviously joking, because there's no such thing that you ever should take higher, but this is a nice. It's diversion, so it means the rejection of the 200 moving was honored, because the lows are not at the same level. They're at the 200 moving average. The right one is higher. B, I have a very small, very nice hammer on the bottom. Hammer is a reversal. I had the previous momentum, so that's what I said before. Momentum always followed by uncertainty, and then I have the next moment, and I get a trend day. That's the reward, and you obviously you finance at that orange box level or a little bit below. You have a nice risk reward ratio to that. That should be, and you don't. That's really important. You don't need to have the low at the blue line. So the low, the stop is not below 3,954, because a lot of people still trade these wide stops. No way. You want always. Maybe you get spiked out and you need a second entry, but the stop in this case is somewhere below that green body of that hammer formation. One to the right, one to the left, one to the left. No, the double bottom bar.
3,960 around that level, or
yeah, exactly. That's way too high.
Well, I just want to clarify that the green isn't a stop. That this was basically, I was just basically
no. That's clear.
Okay.
So double bottom is at the 200 moving average. That's that pink line, turquoise line, whatever. Magenta, that's what this is. The magenta line. Now, averages would trade below the lowest low, which is the one with the yellow circle.
Mm-hmm.
Averages would put the low below the 200 moving average. So that would be somewhere 3957 or something like this. Averages are at 3952. But this should never come back. If you have a double bottom like this on this strength, your stop is below the body of the previous day. So that's 367 or something like this. Basically
below
a little higher.
Candle. Below the huge downward.
No. Okay. Matthew. Sir?
Yes.
Can you make it big again, please?
Okay,
Back. Zoom out further.
Oh.
Here you go. Yeah, no, that was good. The last one was good.
Okay.
Something big like this. Good. Okay.
So
now stretch it a little. Stretch it a little up, down. Further. Stretch it. Okay. Now go to the very left, to the one with the yellow circle. And okay, here. No, go below again. Low. This is where amateurs put the stop, which is the lowest low.
Yeah.
Now go a little higher between the 3954 and the 200 moving average. A little higher. Stop. This is where people who are already in advance put the stop, because they know that this should never go that far again. Which is, and put your hand under the double bottom, please. The hand of your thing under the double, exactly. So this is where amateurs a little higher. This is where semi-professionals. But when you have a clue about the markets and you see that double bottom, see how strong these wicks to the downside are. You don't get a third wick. It's not a high likely probability. So now move it up all the way to the height of the yellow circle. This is where the stop is.
Okay. That's what I meant. Okay. Mm-hmm.
And then you have, as you can tell, about a 1 to 3 risk-reward ratio to financing. And when you do this, and it should get another spike down, you get stopped out at a relatively small percentage loss, and you just try again when the next confirmation signal goes up. So re-entries are way smarter than large stops, is basically what I'm trying to tell you. And obviously, all stops are always depending on the size. So if you should, for whatever reason, not have the scenario where you need all the large stop, you can still trade this if you have the risk-reward ratio, in this case, which you do, of a little bit more than 1-to-1 financing. You can also take the large stop, but then the position size is accordingly smaller, because we always trade position size according to the stop level in regards to
your risk percentage.
Exactly. Okay.
Yeah.
Did that answer part of your question? Okay. And you said you had one more.
Let me have a look real quick. So the third one would be the last time you guys explained the dog leash category. And so I assume it goes in the same direction as the previous two questions. So it's still unclear to me what a sideways call would constitute within the dog leash category.
If the dog, let's take this chart. Imagine that yellow circle is the dog.
Yeah.
Now, Matthew, give me a hand anywhere on the 200 moving average to the left. Not that far, a little bit closer to the dog. Okay, you are the owner. That's the head. You're the one. The owner is always on the moving average.
Yeah,
it doesn't have to be the 200. Can be the 20 or the 40 or whatever your settings are. Now here, the dog is a little bit away. So at some point it has to come back. So your answer is really easy. Each time when the dog is where the owner is, which is when the price is very close to a moving average, that's sideways.
Okay.
Because you have no edge. You have no edge. The edge is nothing else but a moving average. The distance between moving average and price is basically a representation of maximum adverse excursion. And the further this is away, the more the principle of action reaction is applying. The more the dog runs away from you, just always imagine there's these dog leashes where there's a spring inside. So the dog pulls, and at some point, with training, typically that would be a 2.1 maximum excursion. The pull starts strongly, but the dog will basically be yanked back because the leash is simply, you're running out of leash. And then owners typically hit that little button that pulls basically the dog back. Mm-hmm. Because there's a spring leash in these leashes. I have no dog, so obviously you can tell I'm just using poor metaphors. But the point is the price has to come back. So in this case, you would have a very small edge that price has to return back to the 200 moving average. And again, when you say, well, can you quantify this for me a little bit more? Typically have 3 moving averages in a chart, and it's the relationship of them between those 3. So you basically have to ask yourself 3 times if it's exactly between 2 moving averages. That can also be a pot. But the grandest, most easiest identifiable if it's sideways is when price is on a moving average and not away from it.
Okay. Perfect.
You got your money's worth.
Yeah, for sure.
All right. Matthew, you're very welcome. Matthew, is there anything that you have prepared, or should we let other questions in right now?
Yeah, I mean, other questions can come in. I was going to integrate some psychology things, but it's totally fine. I welcome questions. Nice bounce breakout. I was going to go on a daily because that chart was a little wild to do that. That was momentum wise, but
okay. That being said, any questions before Matthew gives us more of the hot juice? That's your field, Matthew.
Okay. We'll check the chat. Yeah. So. Just regarding momentum, even on the daily, if we have just in general, this move, right? It engulfs this entire previous day, so it has better odds for continuation. If it has better odds for at least another day, and versus, let's just say it went straight line up. Right. If it went straight, if this was one candle up, it would have a greater odds to react or be exhausted. Obviously, 2 days is one thing, but let's just say it was actually 6 days and it bounced a little bit and creeped up. So just be aware of that. That if you go from one edge to the bounce to the other, there's less likely that it's going to break through because the first test of a zone. First test of a resistance usually produces the best odds of a reaction. The second retest gives you the best location, and at least for beginning to intermediate trader, it can help you not fade against trends and not fade against volatile neutral days, which is what you saw today. So we saw that things went kind of sideways in the ES. In the overnight, let's just go on a smaller time frame until that CPI number. And when we categorize day types, we within even sideways, you can be aware of different types of day types. So if this day ended, if this was the beginning of the 24-hour sessions and it ended right here, right? This is a pure neutral day. a pure sideways day, where basically it's making a nice, perfect box range with clear highs and clear lows. You can take double tops and double bottoms and shorts and highs on the longs and shorts on this. But as you can see, then when the CPI number, right, we predicted that we just in general, markets tend to drift before the market moving news at 8:30. Let's just go to 8:30. You can see staying out 30 minutes before and at least being aware of this environment so you didn't get stopped out. Because if you had your order here thinking that there wasn't going to be a volatility uptick, I mean, you would have just got smashed. Or if you were thinking about taking, just to describe the zones here a little bit, right? The best zones, the most extreme zones are in blue. I have these marked as pre-market zones. These are key reference. All these zones are key reference areas, and they help with trade location, right? We know that the obvious, if it, price is king, we're looking at where the price is making these patterns. But if they're, when I'm producing a chart and if it's happening within these zones, for example, the Y double top or the Y double bottom on the hourly, and you can see this wasn't necessarily easy to get into psychologically because there wasn't that nice structured. These were whipsaw. This was an outlier day. So for a beginner to intermediate, at least a beginner to novice trader, exercising caution to great trade location was super important, and waiting for these highs and low extremes rather than getting aggressive intraday was super important. That's why there was pretty much a wide space in these. There was nothing really in between that I thought was low risk, right? But at the same time, seeing this struggle here, you'd be willing to jump in again. You don't have to take it to the middle, to the back of the zone. Conservatively, it was to the back. If you don't get in, you don't get in. But if you recognize what's happening, and at least with this, I can look underneath the hood. There was not extreme weakness at this time. There's plenty of reasons to jump in. And initially, the chart did have these two zones ahead of time. Now, the first was based on this candlestick, which halfway between the body to the wick was the entry point, irrespective of the zones. I can get rid of these zones and not use them. But the idea is that if it whipsaw through this, this was a very structured zone in and of itself that I'd be willing to get in again. And the idea of putting in two limit orders, psychologically, you'd have to be here taking 1 hour loss here. You stopped out, you get in again here if it whipsaws down. And, sometimes that would work out or it wouldn't. But if you were only basing this on zones and not price and you didn't take it, then, well, you missed it. There's really nothing to say. I mean, it was ahead of the zone. So one of the just intraday price actions, seeing this buying tail, right, the strong liquidation could have given you enough reason to give in, as well as not seeing excess weakness on the AD line, which I'll go check that out at that time at 9:45. Now, we don't have this luxury in the crypto market. They're not indices. They're the spot. They're at least going along. So basically, the trade location in the daily call on the top down is king. You don't really need this. This is just giving you a little, if you read it right, a peek underneath the hood. So this moment in time is about 9:45. And you can see here there's not excess weakness. This is not at minus 1,500 or even approaching minus 2,000. Now, downtrending conditions would be minus 2,000 or less. It would be, or if it was uptrending, it would be plus 2,000. And sometimes, I'm sorry, for the AD line, these things could just go sideways. Now, this is showing buying and selling pressure moment to moment on a moment to basis. So if this was trending conditions, I would expect to see this at 9:45 a lot more than at minus. It's not an extreme. It's not even at minus 500 to 600. And then when you could even have waited for a slight confirmation on that, almost like a false breakthrough as it popped up to get in and go to market if you didn't get filled because of this whipsaw action. And also at that time, if we go to 9:45 in the AD line, once again, it's just it's not excess weakness or anything. So it's not going against the idea. The idea is based on the idea that trade location is one of the most important attributes in a system, and if you're reading it from a higher time frame perspective to read the market context correctly with a trade plan, your daily call, that's what's going to help you. As long as you're not becoming too precisionist in a sense that you have to have the contextual awareness of when to jump in. This wasn't, see, if let's just say we didn't have this strong evidence of higher time frame buyers here, and of course higher time frame sellers here, and we didn't know who was going to necessarily resolve himself. And quite frankly, this has kind of died down. We don't know because we're still balancing, slight edge to the bulls, but still intraday. No one's really dominating anybody because until they break initial resistance here, anything can happen. So,
would like to interject one point.
Sure. Yep.
What's really become very nicely evident here is when you switch from 5 to 15 minutes. See how clean this trades here in comparison to 5. It really makes all the difference. And knowing that we had the numbers today, and this being basically the dominant figure for this week, from a news perspective, as I announced on Monday, I think I did that. I just stepped aside from that whole day, got positioned, and had a few exits. So the solution for these tricky markets, especially for beginning traders, is stepping away from the noise, just step a time frame higher. And the time frame higher is significant from 5 to 15 because these entries here on the 200 moving average, if somebody is valuing that's support resistance zone, they're primo. There's no risk, zero risk below. It's like super minimized. And as soon as you go to smaller time frames, you in so much heat of data density. It's a totally different world of what you have to think about. And no 200 there to help you. So that's the second maybe, but the second is also very tricky because it's bullish. Basically, you have to be in early. So this chart is so much more difficult to trade than the 15-minute is, because there's also so much more going through your brain. So when in doubt, zoom out is something that I would just wanted to add here.
And I'll add to that. Thank you, Kobe. It's okay to feel the fears this is coming down, and the smaller the time frame, at least for me, it seems more dramatic, right? So if let's just say you wanted to fade somewhere to the bottom, to the half of this conservatively, or you saw this struggling here back and forth, and you wanted to jump in, maybe it would be easier to get in if you zoomed out. What do you think? That's sometimes getting caught up in these smaller time frame dramas is not productive. Now, if you're using it to zero in to help fine tune your execution, that's okay. But that's why, for my execution, I'm 15 is better for me, and for the setups, especially for wide setups, I like the hourly because it keeps me out of that drama. Because I'm already reading intraday stuff moment to moment as it is with the tick and the AD line, and I got to balance out that real time stuff with the higher market context plan. And you can see how this could be addicting. And if you trade a mechanical plan that systematically, it's like each day is so different. I mean, if you came in with a system that trades, maybe this day, which was this false breakdown, especially once it resolved itself here, you have to realize that this zone had real important weight. It was marked green at that point, or at least it is today, based on that move. If you traded that anywhere near a day like this, where you thought that, hey, I want to have that same edge, if this breaks down a little bit, and not being aware of one of the principles that increases volatility could be, like I said, in that list of things that increase the probability of trend, I should also say really that these are increasing. More specifically, is the probability of volatility, which is a big element of trend, but it doesn't equal a trend. As you can see, this is a very volatile sideways day. If it was just this much this day, it would be a pure sideways day with a very low volume, but it isn't, right? It broke to both sides of this range, so this is really a huge battle between larger time frame players, and obviously fading extremes using these double bottoms could be very lucrative on a day like that. As long as you were aware of this and let it not get in too aggressive early and let it tip its hand. There's no reason on this that you need to think you need to fade anything on first test when the market's giving you that location psychologically for a beginning trader to put on real risk of your money. It might be easier to fade that double bottom or wait for the double top. But on first tests of these zones, you are going to get a reaction. This would have happened in the pre-market, right? When I say pre-market, right, it's before 9:30 Eastern. Although sometimes I use Pacific time as well, but this chart's in 9:30 Eastern. In general, with these indices, there's an uptick, and if you weren't aware of this higher time frame context with a plan, we can zoom out to get it. If you just had this much information and say, "Hey, I'm going to trade this breakdown," you wouldn't realize that this day had good odds not to have down based on your daily call plan. So let's zoom out. This is a good example of that. Even though we have this balance, which is multi-week balance, right, with a breakout attempt that broke false breakdown, but then it held because this was a notable move that went from one side of the balance to the other. So, this breakout attempt is a false breakdown, but it doesn't necessarily mean this thing was invalidated, right? Because it eclipsed all this move, we have to look at other things. And right, markets move in a series of thrusts and corrections. So even though now once we have a confirmed breakout on this, right, we expect this potentially to trend higher, it doesn't mean that after we have a move that closes, right, this structure that we expect, okay, now we have to have another trend day and another trend. I mean, that's why we exercise caution, because a lot of the times when people are getting excited, the professionals are already taking profits. And that's when, the idea that, after a really bullish move, I have to, trade a breakout, momentum moves, they usually just don't work. As you can see, this was a volatile sideways day that if we closed right, we're closing at 508. Market closes at 5, so there's a slight edge to the bulls here because we are above the close. But, when we're looking at patterns, right, you just want to stack a lot of different things when we're looking at the story and the narrative that we're creating, and also thinking in social market terms of like who's behind these moves, who's trapped. Today was interesting because there was a lot of, in other environments, it's these trapped retail traders were whipsaws. But in this one, even though it whipsaws, it was indicative of institutional money because of this. Once again, we can go to that. Just the level of viciousness of these volatility of these moves. So so one of the things that I just wanted to discuss, because I know it's getting 5:09 and we don't want to be dragging this on too much longer, but we've talked about a lot of concepts today. I just want to let some of the new folks know that these concepts do become systematized with different sheets that we help folks with. For example, a daily call sheet. There's a quantitative and qualitative trade journal that I highly recommend. They can help you with a entry matrix system that takes a lot of these principles and helps you if you're feeling aggressive to do bad things. Let's say at some point, let's see. This is kind of a bad example, but let's just say for some reason you wanted to buy here expecting this to break out, right? That trade matrix sheet, but they say, hey, even let's say you did your daily call and you knew not to do that, something overwrote, and this is a bad example because I'm not saying this would look good, but just say you did. That trade matrix could be that one last thing on your dial board that can help you say, hey, trade location, no. And then you say, okay, well, like a computer program, you need at least 2 stars to consider going in. And at least one of those stars has to be trade location. Well, this trade, if you bought here, would have no trade location. The day's bias isn't on your side because this is just whipsawing back and forth. The sustained momentum isn't on your side. Just look just, and this is just a bad example because it's a lower time frame. It's not sustaining itself. There's problems going forward. And there's one other concept that can help you, and I'll have to zoom out for that, which would be larger time frame bias. Which, because for some of the people they talk about, when I say the short, the intermediate, let's do that. Maybe we could, at least I'll end with that real quick, because I give different time frames, short, intermediate, and big picture, which can help you with that category. But those combine into one category, which can be weighting what's happening intraday. So like the larger time frame bias in here for these three categories that I marked today, would overall, based on the context, even though the intermediates neutral bullish were breaking out, it's with understanding that we're short-term exhausted, so we're coming in more neutral, meaning we're open to both sides, and especially that the both sides was happening with the idea that we were going to drift sideways in principle based on that market-moving news. So, yeah, coming up with a trade idea every 24 hours in probability, just based on the fact that you have recency bias, is going to work out more often than if you're trying to predict these huge ideas ahead of time. Although I got to say, some of Corby's higher time frame ideas are looking really good for Bitcoin right now. There's been some really good moves. I mean, look how this is moving right now with some of those secret codes he decoded on the higher time frame. Not a bad start to that move. Now, one thing you say is that, when you're looking at trends and we're looking at them in a fractal way, you can look at leg counts on multiple time frames, larger ones. But if you just look at it, usually the start of the move is when I would like to see the bigger candle. Let's just say the bigger candle broke here and now it creeped up out of here. The idea that it reversed it is kind of making me think we might get some, especially up when we hit this with this node here, there might be some exhaustion. It might react down. So the idea is not to get excited when you see this and say, now I want to buy, in a sense. And that's, if we can be patient and wait for the great trade location and follow the daily plan, we'll be better off more often than not. So, yeah, that's my 2 cents, Kobe. I said that's my piece. So we got to see who's still left. Yeah, that's pretty much it. If anyone has any last questions, last call for alcohol. Otherwise, thanks for coming out, and glad to see some new faces. All right, folks. Yeah, this is a good one. Yeah, we'll see you guys on the next one. This is recorded. But for those who got to stay, thanks for your questions. I'm glad we got them answered. Take care, everybody.
Thank you so much, everybody.
Yep.
It was truly appreciated.
We'll see you guys in the room. Adios.